I'm Mike Atwell, Head of Capital Markets for Central Eastern Europe for CBRE, and with me is
Sean Doyle, Director in the Capital Markets team in Poland.
And we've basically decided to sit together this morning to have a chat about the investment market in Poland, and just to give you an update of where we feel the market is and what's actually currently happening. Probably the biggest and most significant change, not a change or sort of influence at the moment, is this weight of capital, which we're all reading about and hearing, that there's more and more capital being allocated to real estate. We certainly feel that. I'm just wondering, I'll ask Sean the question, where do we see that source of capital coming from? Where's the money coming from, and where is it being directed?
Well, it's coming from a wealth of new locations. I mean, we still have the core German funds in the market, sort of driving the market, if you like. But increasingly in the various different bidding processes, we're seeing new names from new locations, say sovereign funds from the Middle East, Southeast Asia show up increasingly. Additionally, particularly in logistics, we're seeing a lot of US capital come into the market, and whether that is direct or backing sort of existing logistics platforms, for example, this is a trend that is sort of increasing.
And that same capital is also seeking retail and office stock. In terms of retail, it's obviously prime stock, and most of this new capital or weight of capital is after prime retail in the big cities and prime offices in Warsaw, but also in the regional cities such as Wrocław, Poznan and Kraków. But Sean, one of the other sort of underlying, I wouldn't say concerns, but trends in the market now is the view on Warsaw. What's happening in Warsaw's occupational market, and what impact is that having on the investment market?
Yeah, it is a burning question on everyone's lips. Warsaw offices in particular. What is happening with the pipeline? What impact is that having on effective rents, vacancy? Certainly vacancy is rising in Warsaw offices. However, it's the breakdown of this vacancy that's the key thing, and it's predominantly in B class. B class vacancy is significantly higher than A class and modern office, brand new office buildings. And I think, contrary to sort of common belief, actually the modern office buildings and grade A buildings, brand new office buildings are performing actually quite well. The vacancy levels are relatively low. And yields
are sitting around that.
Close to the 6% mark. I mean, we're still seeing yield compression. We're still seeing an increasing number of funds, regardless of the large pipeline. There is an increasing number of funds looking at the market, because ultimately the fundamentals of the Warsaw office market are still very, very strong. Every year has been a record year in terms of take-up. Net absorption is very healthy at around 160, 170,000 square meters per annum. Additionally, Warsaw's population continues to increase.
So Warsaw office investment, if it's prime, good quality product, it's still a good buy because there's a long-term positive story there. We see the same in retail, that prime retail has been trading several transactions at 6%. There's a very clear message that 6% is prime retail in the big cities. But where the difference is, if you look specifically at retail, as soon as you go outside of the big major cities, we've seen a big jump from prime of 6% to the only transactions last year were around about 8.5% and even higher. So there is certainly the potential for transactions through this year in medium-sized cities, and it'll be very interesting to see where the yields will come out, probably in the region we hope around mid sevens. But as yet, there's been no transactions at that level. And before we quickly move on to logistics, in terms of yield indications for prime logistics, we've seen a lot of compression recently.
I think prime logistics yields, I mean, in the Czech Republic we've seen an offer at 7% already, and in Poland certainly it's dipped below 7.5% for longer leased prime logistics in a core logistics hub, heading down to 7.25%. And I think this is a trend that we will continue to see, yield compression in prime logistics with the weighted capital.
And the new investors, which we have seen new money specifically targeting logistics, who are the main players?
I guess obviously the key names are the likes have been around for a couple of years now, Blackstone, Hines, but increasingly we're seeing the likes of TPG, Brookfield, Exeter, USAA. There's a large number of these sort of big US capital groups coming in, backing these existing logistics platforms like P3, Gaisley, just to name a few.
Yeah, so the underlying message then across retail, office and logistics, prime stock still in strong demand, yields staying as they are, or maybe a little bit of yield compression. But the major issue is the scarcity of stock. It is extremely difficult to acquire prime real estate across all three sectors. And I think we might see, because of that weight of capital continually chasing prime, we may see that capital moving up the risk curve slightly and looking for more opportunistic, or moving out into regional cities and finding better value opportunities.